Good morning. Why some investors survive market cycles and why others don't. And commercial real estate has always been cyclical, and markets expand and prices rise and credit becomes abundant. And then, inevitably, the cycle turns. Yet something interesting happens during each and every downturn. And some investors thrive while others just disappear. Understanding the difference between those two groups is one of the most valuable lessons a commercial real estate investor or business owner can learn. Market cycles are inevitable, and commercial real estate moves through predictable phases. We have expansion, we have strong demand, rising rents, and new constructions abound. Then you have a peak where prices are elevated and underwriting loosens to make deals work. And contraction is when rents soften and vacancy rise and financing tightens back up. And recovery is when distressed opportunities appear. And many investors only experience one or two cycles in their careers, and those who survive multiple cycles develop a mindset that prioritizes discipline, structure, and risk management. So the investors who fail, chasing momentum is the point. And investors who struggle during downturns typically share a few common characteristics. Over leveraging during boom periods is common, but buying assets based on appreciation assumptions, or ignoring the debt structure risk, or relying on short term financing with uncertain exits. And when cycles shift and interest rates rise and rents slow and liquidity tightens, these deals become fragile, is the point. Now, a property that looked profitable during the boom can quickly become cash flow negative. So let's talk about the investors who survive, discipline over hype. And professional investors approach the market differently. Instead of chasing momentum, they focus on structure and durability. And successful long-term investors typically prioritize a few things, and maybe you could learn something from what they value. But first is strong cash flow. Second is conservative leverage. Third is long-term fixed or at least predictable debt for a short-term period. And stable tenants with diversified income streams. They also maintain liquidity and avoid deals that only work in perfect conditions. So let's talk about debt structure and why that matters more than price. One of the biggest differences between surviving investors and the struggling ones comes down to loan structures. So a deal with a slightly higher interest rate or a longer fixed term or flexible prepayment and a strong debt service coverage ratio can outperform a cheap loan that exposes the property to refinancing risks. So professional investors understand that financing is part of the investment strategy and not just a cost. So let's talk about cash flow and how it's the ultimate protection. During uncertain periods, cash flow becomes king. And properties that generate stable income allow investors to ride out downturns, but also to refinance when markets improve and potentially capture some cash equity there and reinvest during distressed opportunities later. And this is why many experienced investors focus on assets like, say, industrial properties with net leases or grocery anchored retail with many tenants, but also multi-tenant flex space or medical office are really some hot button topics right now. And these sectors tend to remain resilient even when economic conditions soften is why. So patience, it's the hidden advantage. Market cycles reward patience. And many investors who lose money simply buy at the wrong time with the wrong expectations. So those who succeed are those who understand that real estate wealth is built over multiple cycles and not a single transaction. You can't hit a home run every single time. And the most successful investors think in decades, not in months. So what today's investors should remember, with capital markets shifting and interest rates resetting, today's commercial real estate market is entering another transitional phase. And that phase creates both risk and opportunity. And the investors who succeed in the coming years will likely focus on disciplined underwriting, sustainable debt structures, and long-term income stability, but also strategic patience. Because in commercial real estate, survival through the cycle is what creates wealth. So if you're buying, selling, or financing commercial real estate in Houston, Katy, or Fulshire, working with advisors who understand both investment analysis and capital markets can make a significant difference in your results. My name is Bill Rapp. Please visit my website, HoustonRealEstateBrokerage.com, to figure out how to get a hold of me. Love to talk to you more. Have a good day.